Okay, hi guys. I hope you people are doing well. So we are just gonna continue where we had left in our previous session. So I had actually completed 2 of the questions from the latest mock examinations, and now I'm going to complete the remaining 2 questions. Yes, Imran, thank you. I will be reviewing them in the upcoming session. Today we won't be able to do it. So first of all, you already have access to these handouts because I've already shared the links in the WhatsApp group. So let's just start off now. This is question number 3, which we are going to do. Question 3 is about Rajpur. A company quoted on the recognized stock exchange has a reporting date of 31st December 2000 X0. The directors would like advice on the following transactions. So what are the transactions on which they would like advice on? The following exhibits available on the left-hand side of the screen provide information relevant to the question. The lease agreements, which explains the circumstances of the lease agreements. The share-based payment, which explains in details of the share-based payment scheme for a staff. Nagpur's impairment loss, so and so, so and so. The information should be used to answer the question regarding within the response options. Now let's just try to see that what exactly are the information that he is asking us to answer. First of all, it says, using exhibit number 1, explain how the lease agreement should be accounted for in the financial statements of Raipur for the year ended 31st December 2000 X1. So it says how the lease agreement should be accounted for in the financial statement of Raipur for the year ended so and so, so and so. Now let's just try to understand this. Exhibit number 1, can you just give it a try, please? Exhibit number 1. Exhibit number 1. Okay, it says the first lease agreement was signed. The first lease agreement was signed 2 years prior to the reporting date for an item of plant and machinery. The useful economic life of the asset and the lease term were both 4 years. Under the agreement, lease payments increase annually by the rate of inflation over the 12 months. The lease payments increase annually by the rate of by the rate of inflation over the previous 12 months. On 1st January 2000 X0, inflation prior 12 months was 10%. The increase of 10% in the lease payments will apply for the remaining 3 years. A second lease was signed on 1st October X0 for a period of 9 months. It related to the acquisition of a single laptop computer. Accountant has decided to capitalize the cost of the computer and recognize the lease liability. He reasoned that this would lead to a consistent treatment of the first lease above and therefore improve comparability, which he claims is fundamental characteristics of a useful information. Now, first of all, basically what happens is that the first lease was signed 2 years prior to reporting date. Useful life of the asset in the lease term of 4 years. Under the lease agreement, lease payments increased annually by the rate of inflation over the previous 12 months. On 1st January, inflation for the prior 12 months was 10%. The increase of 10% will apply for the remaining 3 years. So what happens is that with respect to the first lease agreement, where the lease rentals are subject to inflation at 10%. So with respect to the first lease agreement where the lease rentals are subject to a 10% inflation, the present value of the lease payment and the lease obligation needs to be calculated when such inflation arises and is expected to change the payment to be made. So it says with respect to the first lease agreement where the lease rentals are subject to inflation at 10%, the present value of the lease payments and the lease obligation needs to be calculated when such inflation arises and is expected to change, expected to bring a change to the payment to be made. The revised lease the revised present value of the lease payment be compared with the existing carrying amount of the leased asset and the lease obligation, and an adjustment to be incorporated for the difference that will arise. With respect to the second lease agreement, the lease agreement is for a period of 9 months, and such leases are exempted from the right of use of asset accounting. This would mean that the lease rentals that no lease obligation to be recognized, and instead the lease rentals shall be recognized as expense in the income statement. So with respect to the second one, you just cannot recognize a lease obligation. You cannot apply the right of use of the asset accounting. You just cannot apply the right of use of the asset accounting. right? Now let's move a bit forward and let's move on to the next scenario of the question. It says using exhibit 2 to Tom how the share-based payment scheme will be treated in the financial statement and how it will affect the analysis regarding EPS and gearing. So can you just try to do this question exhibit 2? Okay, now it says last year Raipur introduced the bonus scheme. All 300 employees were given the right to receive a cash bonus in 4 years time. Cash bonus in 4 years time based on the share price at the time compared to the share price on the date the bonus scheme was introduced. So you are allowed to actually claim this bonus in the form of cash. To be entitled to the bonus, the employees still need to be employed on the vesting days. Tom, a shareholder, does not understand how the bonus scheme will be accounted for. He is concerned by granting such share-based payment transaction that will negatively impact basic and diluted EPS and will result in cash outflow in the current accounting period. Now let's just try to understand this thing. Now, the share-based payment bonus scheme that has been introduced is an example of cash settled share-based payment transaction. Under this transaction, the employee will be provided cash equal to an increase in the value of the shares between today, the grant date, and the vesting date after 4 years. I'm sorry about this, Malik Awan. The class was cancelled yesterday, not today. Okay. The employee will be provided cash equal to an increase in the value of the shares between today and the grant date and the vesting date. Now, see, the expense to be recognized is to be spread over the period of 4 years and would lead to the expense to be recognized is to be spread over the period of 4 years, right? So whatever the expense is going to be, it has to be recognized over a period of 4 years and would lead to recognition of expense and the liability. The only impact that will be on the basic and the diluted EPS will be of the expense that will be charged to income statement 2. Okay, Yannick McCarthy, I will just try to share it after the class. The only impact that will be on the basic and diluted EPS will be of the expense that will be charged to the income statement. Charged to the income statement without any impact on the number of shares. So there is actually going to be no impact on the number of shares at all. Now let's move a bit forward and the third requirement of the question, which is using Exhibit 3, explain with suitable computations how the impairment loss would be recognized. Can you just go through Exhibit 3, please? Okay, for all those who are actually saying that they are not part and parcel of the WhatsApp group, I will just try to see that if I could send across an email to all of you with a link of the WhatsApp community that we are using, so you could become part of this. Okay, now it says that Raipur purchased 100% of the shares of Nagpur several years ago. Nagpur is a cash generating unit with a goodwill of $2 million before current annual impairment review. The current carrying value of the net assets of Nagpur are $10 million, but their tax base is $7 million. An impairment review of Nagpur revealed an impairment loss of $3.6 million. Directors wish to know how the impairment loss will be accounted for and how it will be accounting for deferred tax. Impairment losses are not allowable expense for the taxation purposes. Now let's just try to understand that how exactly is this all going to be. It says the current carrying amount of the net assets are 10 million with their tax, but their tax base is $7 million. Okay. The impairment review of Nagpur revealed the impairment loss to be 3.6 million. The impairment loss, how it will be accounted for and how it will affect the accounting for deferred tax and so on, so on, so. Impairment losses are not allowable for taxation purposes. See, what happens is that the carrying amount of the net assets is 10 million. The tax base is 7 million. Taxable temporary differences are of 3 million. The deferred tax liability at 30%. How much is the tax rate given? Tax rate is 30%. Is this into 0.3, 0.9 million. The goodwill is 2 million. Carrying amount of net assets is 10 million. The impairment loss to be allocated as under impairment loss to goodwill is going to be 2 million. Other net assets is going to be 3.6 million minus 2 million, 1.6 million. So revised carrying amount of net assets would be 10 million minus 1.6. Tax base is 7. Revised temporary difference is 1.4. Revised deferred tax liability at 30% is going to be this into 30% is 0.42. Now see, what actually happens is that I've done some calculations. Now I'll just discuss this. Before the impairment review, the carrying amount of the subsidiary along with goodwill in the consolidated financial statements would have been $12 million less $0.9 million of deferred tax liability. The impairment loss of 3.6 million is to be allocated as $2 million to goodwill and the remaining $1.6 million to the other net assets. The revised carrying amount of the net assets will be the revised carrying amount of the net assets will be the revised carrying amount of the net assets will be $8.4 million and the deferred tax liability on them will be $0.42 million. Will be $0.42 million. Requirement was how the impairment loss will be accounted for in the group accounts and so on so on. So this is how the revised carrying amount is going to be. You get my point? Now let's move on to the last part of the question, and that is basically exhibit number 4. That is basically exhibit number 4. Explain with suitable calculations how the bonds will be accounted for in the Raipur's financial statement. Explain with suitable calculations how the bonds will be accounted for in the Raipur's financial statements for year ended 31st December X0. Can you go through this, please? Exhibit number 4. Can you go through exhibit number 4? Yes, unless and until there is a specifically impaired asset. Unless and until there is a specifically impaired asset. Yeah, here you go. Exhibit 3 solution. Yeah, give it a try, please. Okay, now let's just see that it says on January 2000 and X0. On 1st January 2000 X0, Raipur purchased $300 million of bonds at par. The bonds are due to be redeemed in 10 years' time, with Raipur also receiving 10% annual interest annually in arrear. The effective rate of the interest on the bond is 15%. Raipur often holds bonds until the redemption date but will sell prior to maturity if investments with higher returns become available. Now, see, if you are going to sell it and if the investments in the higher returns becomes available, so you just got to understand this thing that basically it's one of those bonds because you see there are three categories. One of them is financial asset at amortized cost. The other one of them is a financial asset at fair value through P&L. And this is a financial asset at fair value through other comprehensive income. So if there is a bond which you might sell, which you might not sell, then it's actually called financial asset at fair value through OCI. Bonds are deemed to have lower credit risk at inception. On 1st December, Raipur received the interest due on the bonds. Fair value of the investment in the bonds at 31st December X0 was $250 million. Based on information available at 31st December X0, bonds are deemed to have high credit risk. Financial team of Raipur calculated 12 months of expected credit losses to be $1 million for the bonds as at 1st January X0. Lifetime expected credit losses at 31st December X0 was $10 million, right? Now let's just try to see this. So basically what's going to happen is that, first of all, I'll just do some of the accounting for these bonds, which is 300 million of the bonds at par. The bonds are due to be redeemed at par at premium in 10 years' time. 1st January X0. The bonds were to be of $300 million. Effective interest at the rate of 15%. Is this into 15%? Cash interest at the rate of 10%. Hence, 31st December X0. This is gonna be the sum of all this, 315. The fair value at this date is $250 million. Now, what is actually going to happen is that you would say that, okay, now let's just try to incorporate this also. The expected credit losses, 1st January X0, is 1 million. Increase in loss allowance is going to be this. Now just try to understand. The bonds are being held. The entity's investment in the bond will be classified as at fair value through other comprehensive income. This is because the bonds are initially recognized. The bonds are held with an intention till maturity, and the entity can sell these bonds also, provided it gets higher returns. The bonds will be accounted for using amortized cost approach. However, at the end of each year, the bond will be remeasured to fair value with the gains/losses to be recognized in OCI. Furthermore, there are loss allowances with respect to the credit losses over the period of the life of the bond. At the time of initial measurement, a loss allowance of $1 million is to be recognized in the income statement. As at 31st December X0, since the risk has become higher, the total loss allowance to be recognized shall be 10 million with a charge of $9 million to be recognized in the income statement. So the carrying amount, the interest income to be recognized in the P&L shall be 45 million. The expense to be recognized in P&L for the impairment for the expected credit losses shall be $10 million. Plus, in addition to this, a loss on remeasurement to be recognized in the OCI of $65 million. So this is how the total overall accounting is gonna be for this bond. Yeah, is that okay? Okay. For the 65 for the OCI, I got it like this. See, um, the initially carrying amount was 300, then the effective interest at the rate of 15% was this. Cash interest at the rate of 10% minus this, so resultingly the carrying amount becomes 315. The fair value is 250 million. The fair value is 250 million, and hence resultingly it's 65 million. Okay, lovely. So I hope that you people would have actually got it. Unfortunately, I mean, because I cancelled the class yesterday because I had an emergency. The loss allowance would actually be recognized in the P&L. So because of an emergency, I had to cancel the class yesterday. So that is why I have to actually conduct several additional classes today. So I'm just reducing the time for today's class. I will continue having a session tomorrow. The timings for the tomorrow's session would be a bit different. I will update you people about the timings. I think you all are part and parcel of the WhatsApp community, I guess. I'm just assuming that you people are part and parcel of the WhatsApp community for the SBR. In case if you are not, I'm just gonna try and see if I could just share the link now. Just a second, allow me a minute. I'll just try to share the link. So we'll continue in the next session tomorrow and we'll go through the further questions.